Hello, and welcome back to Boni's Life, the channel where we navigate the chaotic, exhilarating, and often downright confusing world of crypto with a little bit of wit and a whole lot of data. I'm your host, Boni, and today we're tackling the $1,000,000 question, or given the current market, perhaps the $90,000 question: how in the world do we trade this market? Whether you're a seasoned trader who dreams in candlesticks, a mid-term strategist with the patience of a saint, or a long-term investor who buys and holds like your life depends on it, this episode is for you. We're going to dissect the current market, figure out what beast we're actually dealing with, and lay out some actionable strategies to help you navigate these choppy waters. We'll be diving deep into the numbers, looking at everything from the global economic stage to the nitty-gritty of on-chain data. So grab your coffee, silence your notifications, and let's get ready to make some sense of this beautiful madness. So let's get right to it. What kind of market are we in right now? Are we in a raging bull market, a soul-crushing bear market, or something in between? Well, if you've been paying attention to the charts lately, you'll know it's not quite that simple. After a spectacular run-up to an all-time high of $126,000 in October, Bitcoin has taken a bit of a breather, correcting down to the $90,000 range. Now, a 27% haircut might sound scary, and for those who bought the top, it certainly is. But for the rest of us, this is what we call a correction within a bull market. Think of it like this. A bull market is like a rocket ship. It doesn't just go straight up. It has stages. It fires its boosters, detaches a stage, and then continues its journey. This correction is simply a stage detachment. It's a healthy and necessary process that shakes out the weak hands, reduces leverage, and builds a stronger foundation for the next leg up. The Fear and Greed Index, currently sitting at a chilly 29, which is in the fear territory, tells us that a lot of the froth and euphoria has been washed out of the market. And that, my friends, is often a good thing. It means there's more room for the market to grow. Now, let's zoom out from the charts for a moment and look at the bigger picture. What are the fundamental forces driving this market? Because as we all know, technical analysis without fundamental analysis is like trying to navigate a ship with a compass but no map. You might know which way is north, but you have no idea where you're going. First, let's talk about the big kahuna, the Federal Reserve. The Fed has been on a mission to cool down the economy, and they've been doing that by raising interest rates and reducing their balance sheet, a process known as quantitative tightening. This has been a major headwind for risk assets like crypto. But here's the good news. The tide is turning. The market is now pricing in an almost 90% chance of another interest rate cut in December. This would be the third cut since September, and it signals a major shift in the Fed's stance. As Cathie Wood of ARK Invest recently said, the end of quantitative tightening, which is expected to happen on December 1st, is a form of de facto easing. In other words, the Fed is about to open the floodgates of liquidity, and a lot of that money is going to be looking for a home. And right now, Bitcoin is looking like a pretty attractive home. And then there's the institutional adoption story. It's no longer a question of if institutions will adopt crypto, but how quickly. The launch of Bitcoin spot ETFs has been a game changer, and we're seeing a steady inflow of institutional capital into the space. BlackRock, the world's largest asset manager, is leading the charge, and the rest of Wall Street is following suit. We're even hearing whispers of sovereign wealth funds looking to add Bitcoin to their treasuries. This is not just a retail-driven market anymore. The big boys are here, and they're here to stay. As Joseph Radzinski, a futurist at JT Consulting, put it, institutions are just able to start getting involved. It's just the beginning. And when you have that kind of institutional firepower coming into a market with a fixed supply, well, you don't need to be a rocket scientist to figure out what happens next. All right, let's put on our technical analysis hats and dive into the charts. This is where the rubber meets the road, where we can identify key levels and potential trade setups. As of right now, Bitcoin is hovering around the $90,900 mark. Our immediate support level is in the $87,000 to $88,000 range. This is a critical zone that has held up well so far. If we break below that, our next major support is at $82,000, a level that Glassnode's on-chain data also points to as a significant area of interest. On the upside, We're facing resistance at the $92,000 to $93,000 level. A clean break above that could send us to the psychological resistance of $100,000 and then on to the 200-day moving average, which is currently sitting around $110,000. Now let's talk about volume. We've seen a significant drop in trading volume since the October highs. This is actually a bullish sign. It tells us that the selling pressure is exhausting and the market is in a phase of accumulation. The big players are quietly buying up the supply from the panic sellers. We're also seeing a healthy decrease in open interest, which means that a lot of the risky leverage has been flushed out of the system. This creates a much more stable foundation for the next move up. The Bitcoin dominance is also creeping up, which is typical in a market correction. It means that investors are flocking to the relative safety of Bitcoin. And it's a sign that the market is getting ready for its next big move. So, with all of that in mind, how do we actually trade this market? Well, that depends on what kind of trader you are. Let's break it down. For the short-term trader, the scalper, the day trader, your world is the 1 hour, 4 hour, and maybe the daily chart. You live and die by volatility. Right now, the market is giving you a beautiful range to play in. We're seeing clear support and resistance levels, which is a scalper's dream. Your strategy is to trade the range. You're buying at support around the $88,000 to $89,000 level, and you're selling at resistance around $92,000 to $93,000. Your stop loss should be tight just below the support level, because if we break down, you don't want to be holding the bag. A breakout above $93,000 on high volume is your signal to flip long and ride the momentum up to the next resistance level, which is around $95,000. Remember, as a short-term trader, you're not trying to catch the whole move. You're taking small, consistent profits. It's a game of inches, not miles. For the mid-term trader, the swing trader, your time frame is the daily and the weekly chart. You're looking to catch the bigger swings in the market. Right now, your strategy is to accumulate in this consolidation zone. You're not trying to time the exact bottom, but you're buying in the $85,000 to $88,000 range, dollar cost averaging your way in. Your first target is the psychological resistance at $100,000. Your second target is the 200-day moving average at $110,000. Your stop loss is a daily close below the major support at $82,000. You're also keeping a close eye on the fundamental catalysts we talked about earlier. A confirmed rate cut from the Fed in December is your signal to add to your position. You're playing the bigger trend, and right now, that trend is still bullish. For the long-term trader, the investor, the hodler, your time frame is the weekly and the monthly chart. You're not concerned with the daily noise. You're looking at the big picture. For you, this correction is a gift. It's an opportunity to add to your long-term position at a discount. You're buying in this entire $82,000 to $95,000 range. You're not using a stop loss in the traditional sense because you're confident in the long-term value of Bitcoin. Your stop loss is a fundamental one. Has the long-term thesis for Bitcoin changed? Is institutional adoption slowing down? Is the network security compromised? As long as the answers to those questions are no, you're holding on. Your price targets are the previous all-time high of $126,000 and then the expert predictions of $150,000, $200,000 and beyond. You're not just a trader, you're an investor. And you're investing in the future of finance. Now, let's talk about some of the key market indicators that we need to keep our eyes on. These are the vital signs of the market, and they can give us early warning signals of what's to come. First, let's look at volume. As I mentioned earlier, the 24-hour trading volume for Bitcoin is currently sitting at around $37.17 billion. This is down significantly from the highs we saw in October. Now, some people might see this as a bad thing, but I see it as a positive. Decreasing volume during a correction is a sign of capitulation. It means that the sellers are running out of steam, and the market is getting ready for the next move. When we see volume start to pick up again, especially on a move to the upside, that's when we know the bulls are back in control. Next, we have the total market capitalization. The global crypto market cap is currently at $3.17 trillion. This is down slightly from the peak, but it's still a massive number. It shows that despite the recent correction, there's still a tremendous amount of capital in this space. And remember, this is a global market. It's not just about the US. we're seeing adoption happening all over the world, from Asia to Europe to Latin America. This is a truly global phenomenon. Then we have the Fear and Greed Index, which, as I mentioned, is currently at 29, firmly in the fear territory. This is actually a contrarian indicator. When everyone is fearful, that's often the best time to be greedy. It means that the market has been oversold, and there's a lot of upside potential. Historically, some of the best buying opportunities have come when the Fear and Greed Index is at its lowest. Now let's talk about open interest. This is the total value of all outstanding derivative contracts, like futures and options. The current open interest is around $130.44 billion, which is down slightly from recent highs. This is a healthy sign. It means that a lot of the risky leverage has been flushed out of the system. When open interest is too high, it creates a fragile market that's prone to violent liquidations. A decrease in open interest creates a more stable foundation for the next move up. And speaking of liquidations, we've seen about $119.65 million in liquidations over the past 24 hours. This is down significantly from the peak of the correction. Liquidations are what happen when traders get margin called and their positions are forcibly closed. A decrease in liquidations is a sign that the market is stabilizing and that the worst of the selling pressure is behind us. All right, let's zoom out even further and talk about the global events that are shaping this market. Because as much as we'd like to think that crypto exists in a vacuum, it doesn't. It's deeply interconnected with the global economy, and what happens in Washington, Beijing, or Brussels can have a profound impact on the price of Bitcoin. The biggest event on the horizon is, without a doubt, the Federal Reserve's December meeting. As I mentioned earlier, the market is pricing in a near 90% chance of another rate cut. This is huge. It signals a major shift in the Fed's policy stance from tightening to easing. And when the Fed eases, it's like opening the floodgates of liquidity. Money becomes cheaper, and investors start looking for higher returns in riskier assets. And right now, crypto is one of the riskiest and potentially most rewarding asset classes out there. But it's not just about the rate cut, it's also about the end of quantitative tightening. The Fed has been shrinking its balance sheet from a peak of $9 trillion down to $6.6 trillion. This has been a major headwind for risk assets, but according to Cathie Wood, the Fed is expected to end this process on December 1st. This is a form of de facto easing, and it's going to inject a lot of liquidity back into the system. Think of it like this. The Fed has been sucking money out of the economy, and now they're about to start pumping it back in. And a lot of that money is going to find its way into Bitcoin. Then there's the institutional adoption story. We're seeing a steady stream of Bitcoin spot ETF inflows, which is a sign that institutional investors are getting more comfortable with crypto. BlackRock, the world's largest asset manager, is leading the charge, and the rest of Wall Street is following suit. We're even hearing rumors of sovereign wealth funds and central banks looking to add Bitcoin to their reserves. This is a massive shift in the narrative. Bitcoin is no longer just a speculative asset, it's becoming a legitimate store of value, a digital gold for the 21st century. And let's not forget about the geopolitical landscape. We're living in a world of increasing uncertainty. There are tensions in the Middle East, trade wars between the US and China, and political instability in many parts of the world. In times of uncertainty, investors look for safe havens, and increasingly Bitcoin is being seen as a safe haven asset, a hedge against inflation and geopolitical risk. It's a decentralized, censorship-resistant asset that no government can control. And in a world where trust in traditional institutions is eroding, that's a very attractive proposition. So, what are the key triggers that we need to watch for in the coming days and weeks? What are the signals that will tell us whether this market is about to take off or whether we're heading for more pain? On the bullish side, the first trigger is a daily close above $95,000. This would be a clear break of the current resistance level, and it would signal that the bulls are back in control. It would likely lead to a quick move up to the psychological resistance at $100,000, and then on to the 200-day moving average at $110,000. Another bullish trigger is the Fed's rate cut announcement in December. If the Fed delivers on the expected rate cut, it's going to be a major catalyst for risk assets, including crypto. We're also watching for a surge in Bitcoin ETF inflows. If we see a significant increase in institutional buying, that's a sign that the big money is getting back into the market. And finally, a break above $100,000 would be a massive psychological boost. It would likely trigger a wave of FOMO buying and could send us to new all-time highs. On the bearish side, the first trigger is a break below the $85,000 support level. This would be a sign that the correction is deepening, and it could lead to a move down to the major support at $82,000. Another bearish trigger is a failed retest of the $88,000 level. If we bounce up to $88,000 and then get rejected, that's a sign that the bears are still in control. A negative surprise from the Fed, such as a decision to hold rates steady or a hawkish statement, could also send the market tumbling. And finally, a major liquidation event where we see a massive spike in liquidations would be a sign that the market is still fragile and that we could see more downside. Now, before we wrap up, I want to talk about something that's absolutely critical, and that's risk management. Because no matter how good your analysis is, no matter how perfect your trade setup is, if you don't manage your risk properly, you're going to lose money. It's as simple as that. First, let's talk about position sizing. This is the amount of your portfolio that you allocate to each trade. For short-term traders, I recommend risking no more than 2 to 5% of your portfolio on any single trade. For mid-term traders, you can go a bit higher, maybe 5 to 10%, and for long-term investors, you can allocate a larger portion of your portfolio, maybe 10 to 30%, depending on your risk tolerance. The key is to never risk more than you can afford to lose. Remember, the goal is to stay in the game for the long haul, not to blow up your account on a single trade. Next, let's talk about leverage. Leverage is a double-edged sword. It can amplify your gains, but it can also amplify your losses. For short-term traders, I recommend using no more than 2 to 3 times leverage. For mid-term traders, 1 to 2 times leverage is more appropriate. And for long-term investors, I strongly recommend avoiding leverage altogether and sticking to spot trading. The crypto market is volatile enough without adding leverage to the mix. And finally, let's talk about stop losses. A stop loss is an order that automatically closes your position if the price moves against you. It's your safety net, your insurance policy. For short-term traders, your stop loss should be tight, just below the support level. For mid-term traders, your stop loss can be a bit wider, maybe a daily close below a major support level. And for long-term investors, your stop loss is more of a fundamental one. Has the long-term thesis changed? If not, you hold on. So, to wrap it all up, where does that leave us? Well, we're in a correction within a bull market. Bitcoin has pulled back from its all-time high, but the long-term trend is still intact. The fundamentals are strong. The Fed is about to ease, institutional adoption is accelerating, and the global macroeconomic environment is becoming more favorable for risk assets. The technicals are showing us clear support and resistance levels, and we have a range to trade in. For short-term traders, this is a time to be nimble and to trade the range. For mid-term traders, this is a time to accumulate and to position yourself for the next leg up. And for long-term investors, this is a gift, an opportunity to add to your position at a discount. The key triggers to watch are a break above $95,000 on the bullish side and a break below $85,000 on the bearish side. The Fed's December meeting is going to be a major catalyst, and we're also watching for a surge in Bitcoin ETF inflows. But no matter what happens, remember to manage your risk. Don't over-leverage, don't overtrade, and always have a plan. Oh, and before I let you go, let me share one more thing that I think is really important. We've been talking a lot about the numbers, the charts, the technical levels, but at the end of the day, trading is as much about psychology as it is about analysis. The market is driven by human emotions, fear, greed, hope, and despair. And if you can master your own emotions, if you can stay calm when everyone else is panicking, and if you can stay disciplined when everyone else is getting greedy, you're going to have a massive edge. I've seen so many talented traders blow up their accounts, not because they didn't understand the market, but because they couldn't control their emotions. They would get scared and sell at the bottom, or they would get greedy and buy at the top. They would revenge trade after a loss, or they would over-leverage after a win, and eventually they would lose everything. Don't be that trader. Develop a trading plan, stick to it, and don't let your emotions dictate your decisions. This is easier said than done, I know. But it's absolutely essential if you want to succeed in this market. And remember, there's no shame in taking a break. If you're feeling overwhelmed, if you're losing sleep over your trades, if you're constantly checking the charts, step back, take a walk, spend time with your family, do something that you enjoy. The market will still be here when you get back. And you'll come back with a clearer mind and a better perspective. Trading is a long-term game, and you need to take care of yourself if you want to play it well. This is a marathon, not a sprint. The crypto market is going to continue to be volatile, and there are going to be ups and downs along the way. But if you stay disciplined, if you stick to your strategy, and if you keep learning and adapting, you're going to do just fine. The future of finance is being built right now, and we have a front row seat. So buckle up, stay focused, and let's make some money. That's all for today's episode of Boni's Life. I hope you found this analysis helpful. If you did, please give this video a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss any of our future episodes. And if you have any questions or comments, drop them down below. I love hearing from you guys. Until next time, trade smart, stay safe, and remember, in crypto, fortune favors the informed. Alright, that's really it for today. Thank you so much for watching. I'll see you in the next one. Peace out.